with this argument is that all these countries are doing intervention in the foreign exchange market in a sterilized way. That means that all the liquidity that is poured into the economy to buy the reserve is taken out, putting internal debt. That means that reserves are not being used as a monetary instrument, and there is no reason a priori to think that that will really affect the value of the currency. The value of the currency is more likely to be established by the rate of return compared to foreign currency, or by other fundamentals such as terms of trade or the external position of the country, but not by these changes in the balance sheet of the central bank that doesn't affect the actual liquidity in the market. That, of course, depends on the level of financial integration and financial development of the country. Now, a very interesting development in some countries is that reserves are being accumulated in a very transparent fashion. The regular way before was to do it in with a surprise, to surprise the market. Now it's being done in a very transparent fashion, and the idea is to avoid to the maximum excess volatility in the market. Is not to introduce extra volatility in the market. A case in the Central Bank of Chile that announced last April that will buy $8 billion US in reserves. That is about half of the level of reserve before the intervention, and was announced that will be done since the next day until 12th of December. It was announced that will be a first stage of 20 days of buying 50 millions every day. It was announced the time, 10 a.m. every day then they changed it to a half an hour span because the market froze a few minutes before 10 a.m. The market was totally frozen. So they put some uncertainty on the time, but it's just half an hour span. They further announced that the sterilization will be done with short-term bonds. So everything was very transparent. The exchange rate devalued by 3% the same day of the announcement, and we have not seen much more effect since. You can call it not a huge effect, but there was some effect. What is interesting is that later in the month there was an announcement of the specific papers that were going to be used to sterilize. So first was said short-term, then they said very specifically which papers, and that introduced a lot of volatility on the interest rate market. So transparency actually is good not to create excess volatility, but doesn't ensure that this doesn't happen. Another policy has been capital controls to capital flows. And here we have a few experiences. Colombia has a very long experience with capital controls, and the way they're implementing this is that they have a 40% unremunerated 6-month mandatory deposit on the central bank. So with the exception of FDI, direct investment. So any money you bring into the country by foreigners, they have to make a deposit for 6 months. 40% of the money stays in the central bank for 6 months with no remuneration. That obviously affects more the shorter the capital enters. So if you enter a capital for 1 day, the tax is huge. And the intention here is to tax speculative capital flows. Another example is Peru, that has put a 0.05% tax on international transfers, except those that do not leave the financial system. And here Peru does not make a difference between domestic or foreign capital. If you transfer money abroad or from abroad to Peru, you have to pay a tax. It's a sort of a Tobin tax. Brazil has not introduced capital controls yet, but they are talking, the president of Brazil is publicly considering capital controls. They are talking about it very seriously, but probably because they are talking is a sign that they are trying to delay it. What happened in Chile? Chile used to have capital controls in the beginning of the 90s, and after the Asian crisis of 1998, that we got contagion from this crisis, they were eliminated. So the senators now is asking for controls to be brought back. But the president of the central bank, of the independent central bank, argued against these capital controls on 3 grounds. First, he said that are very difficult to implement. Entrepreneurs find ways to circumvent these controls. I would say that the ones that most benefit from this type of capital controls are lawyers and accountants that are paid to circumvent these controls. Second, that they may have a perverse distribution effect. The big enterprises can circumvent the controls and pay low interest rate for foreign capitals, while the small entrepreneurs have to pay the burden of the cost. So that's the second reason, is that it hurts more the small entrepreneurs. And third reason for Chile is that capital flows these days are mostly handled by Chileans. So if you put a tax on foreign capital flows, this will have no effect. These are the 3 reasons given by the president of the central bank. That seems to me very reasonable. To conclude, first of all, I would say that since the early 90s, many countries in Latin America have made substantial progress in consolidating their public finance. Following a long period of fiscal indiscipline, which resulted in the mentioned chronic inflation, budget deficit was trimmed. As a result, the fiscal policy stance has become more reactive to changes in indebtedness, and some countries have worked toward making fiscal consolidation more permanent by improving public expenditure management and control, as well as upgrading budget institutions. Without fiscal discipline, it's virtually impossible to reach inflation control. I think that's the main lesson Latin American countries have learned throughout the years. In the current event, the temptation to increase fiscal spending is even bigger. It's very big for Latin America. On the one hand, is the need to help those that are affected by the high inflation, especially food and energy prices, and on the other hand, income of governments is going up rapidly, and there is a lot of pressure to increase spending and to reduce government surpluses. In this respect, Chile provides an example that I mentioned earlier, which is the Fiscal Rule. The Fiscal Rule was implemented in the year 2000, and according to the rule, spending depends on structural income, not on current income. And structural income is determined by a trend GDP and long-term price of copper. I have to remind that about 10% of income in Chile, of government income in Chile, comes from the mining sector. The trend GDP and long-term price of copper is determined by a group of experts, independent, and that has allowed the government to run a surplus of almost 10% for 2 years, and by the end of 2008, Chile will be, for the first time in its history, a net creditor to the world, and will have savings abroad that will amount to more than 20% of GDP. That is a totally new situation for Chile. I would say that fiscal spending is, increasing fiscal spending is the best recipe to make things worse. You will have more inflation and a more appreciated exchange rate. So it's really the best you can do to make things worse. Another basic historical lesson that some Latin American countries are following refers to policy coherence. It is just not possible to increase growth, depreciate the value of the currency, and reduce inflation all at the same time. And we have learned through years of trying very creative combination of policies in Latin America. None has succeeded. It's just not possible. this is not only in theory. The experience shows that the best central banks can do is to smooth the cycle in order to provide stable macroeconomic environment. Exchange rate appreciation actually helps reduce inflation in the context of higher international prices. That's another thing that is being allowed now, is exchange rate appreciation. So what are the lessons? If I have to make a bullet of lessons, will be first, fiscal discipline and coherence of policy are the basics. Second, interest rate increases are the most common policy and have helped contain further increases in aggregate demand. Third, price controls are very costly. They introduce a lot of distortions, a lot of social unrest, but in some particular cases you may need them. You just cannot go around them, but you have to make sure that this is the exception, like the Mexican tortillas, and not the rule. Reduction in tariffs may also work, but if tariffs are relatively high, it's not the case of Latin America. Anyway, you have to beware of fiscal implications for countries where tariffs are a big part of fiscal income. The experience with export taxes has been not that successful. They're again very distortionary. Argentina, Bolivia, and Venezuela are providing new important evidence in this respect. And this is particularly true if the increase in price is thought to be relatively persistent and not transitory, as I think is the case in in foodstuff and energy prices today. Accumulation of international reserves in Latin America may probably not be a bad idea, but from the perspective of decreasing the financial vulnerability of the countries, there is no evidence that this policy helps to avoid the appreciation of the currency. International academic studies do not show strong evidence for this case, very weak evidence. And the recent intervention in Latin America goes in the same direction. There is no evidence that those countries that are intervening more aggressively are having less appreciation of their currency. The intervention of Chile had an effect of 3% on the currency, and it was done at the same time that interest rate bias was removed. A bias to increase interest rate from the central bank was removed. So expectation of interest rate went down, and at the same time that the dollars stopped depreciating with respect to international currencies. So I would say at most was 3%, and the rest was a little bit of luck. That even though it is true that the appreciation of the exchange rate can really damage certain sectors of the economy and can affect the source of income and work of many, but at the same time it is important to keep in mind that the exchange rate appreciation is an important mechanism to contain inflationary pressure, and that inflation, especially when it concentrates on food and energy, hits harder the poorer. Let me just show very rapidly the case of bread. And you see here for these South American countries that those that had allowed the exchange rate to appreciate the most had the price of bread had increased the least. So actually it works to contain price, especially for countries that are importing food and energy, to contain the price specifically of food and energy. So it's a measure that goes in favor of the poor. And additionally, if capital inflows are a problem, reducing volatility of the exchange rate only helps to increase capital inflows. Appreciation of the currency and uncertainty of its future value reduces the incentive to bring capital, increases the currency risk, reduces the expected rate of return. That's what I have to say. Thank you.
Igal, thank you very much for that. I think we've seen throughout our sessions today a progression in the thinking. We heard from Hans earlier, where he outlined the pressures that are driving inflation up and the fact that we've moved into a very much an inflationary period. We heard then from Romwald, where he was talking about the policies that are needed, the need to look at tighter monetary policy, also the need to allow your currencies to appreciate. And we've heard now very much a specific experience from Igal, coming from a country that has had to deal with high inflation of record levels during the 1970s, and how they've managed to wrestle with that by taking very, very tough decisions. And of course, overall, he's mentioned the need for fiscal discipline to maintain a consistent suite of policies. You're not going to be able to do everything, and also the need to allow, in certain cases, exchange rate appreciation to deal with internationally higher prices. Now, as we've heard today, not all of those measures are going to be applicable to all countries. In some countries there is a supply issue and there is a need to build more infrastructure. In other countries there is a demand issue and the need to increase interest rates. But there is no one size fits all. I think that has been the message that we've heard very much today. I'd like to open this up now to some discussion. We do have Igal here and also Deepak. Let me start in Bangkok. Again, if I could ask you to keep your questions fairly succinct, fairly short, and we can group them together and try to get a collective response. But let's first of all start with Bangkok. Any questions?
Thank you, Stanley. I guess one question here is that to Igal, you've mentioned that appreciation is probably the best way to tackle with inflation, but your slides also show that countries in Latin America who's facing inflation is trying to also prevent their currencies from appreciating as well. So how would you make of those policies? What do you think would be the better way to go? So do you agree with what these governments are doing? And I guess there's a question from the floor at that. In the case of Thailand, because countries in East Asia, like especially Thailand, has always had pretty prudent fiscal stance. So we're not probably not going to see a lot of cuts in the fiscal spending. So instead, the government has tried to tackle inflation by other ways, and one of the ways they have done is actually to raise minimum wages and also wages for public servants. So we would just like some of your comments on that. Is this the starting of the second round effects? Thank you.
Thank you for that. Let me go to Indonesia. Jakarta, any questions?
Same question as in Thailand. We are also having a pretty tight fiscal stance, and the government recently even increased domestic fuel prices to tackle with the increased subsidy. Again, appreciation doesn't seem to be happening a lot in Indonesia. We should be having someone from Bank Indonesia to answer this question as to why the government of Indonesia is not pushing that agenda. But again, my question, you are both saying we should or shouldn't be doing it. Thank you.
Thank you. Let me go to Papua New Guinea. Do you have anything to add?
I wanted to ask a specific question on the monetary policy regime that Chile has in place, the inflation targeting, especially now in the light of rising global prices. How effective do you think the monetary policy regime that you currently have will be in terms of addressing the growth in inflation globally?
Thank you. Okay, I'll get some responses to those and then we'll move back around to some of our other countries. We'll go to Mongolia in a moment. But let me just start with this question that came from Bangkok and also Jakarta. Tight fiscal stance there, they're fairly prudent. The government trying to raise minimum wages, for instance, in Thailand. Is that dangerous? Does that lead to a second round of inflationary pressures? And the question of Jakarta is appreciation not happening. Is that needed? First of all, from you, Igal, and then Deepak, a comment.
Well, first let me say that it's very hard for me to give opinion on countries that I don't know in detail. I would love to know, I would love to go into details, but the details are really the meat of everything, and you need to know that in order to give a well-informed opinion. First, about the question on appreciation, if it's the best way to tackle inflation, why Latin American countries are trying to avoid appreciation. A good question for policy makers. First of all, I would say it's not the best way to tackle inflation. It's one of the ways to tackle inflation. If you allow some appreciation, you will, if you don't allow appreciation, all the burden will rest on domestic demand. And you will have to raise more interest rate and lower more the growth of GDP in order to get the same result. So what you want is to have a combination of both. Is to have a GDP slowdown, relative slowdown, and an appreciation of the exchange rate, both together. I think the combination is the best recipe. And what Latin American countries are doing is, the problem that Latin American countries are facing is that the price of primary goods is what is driving the appreciation of the exchange rate. In fact, as I show you, the exchange rate is actually appreciating very, very strongly, more than 20% in many countries in less than a year. But the problem with that is that the ones that get hurt are manufacturers, and that goes against some idea of long-term development in which you want manufacture and high value-added enterprises to succeed. So what the countries are trying to do is to balance. It's not to allow not to allow too much of an appreciation. I would say with very little success, and many times it's more a political issue than an actual measure. What you can see is that buying reserves or capital controls don't really help, are not very successful. So I would say that not much is really being done, and that what these countries are doing is increasing interest rate, allowing the exchange rate to appreciate. Another question was about raising minimum wages and public servants. Again, I would say here is where inflation mixes up with politics and with pressure groups, and you start building second round effects. I think central banks, if they have any independence, they are the institution to call, that are called to help in this, to prevent this phenomenon, calling them second round effects because they are second round effects, showing that this is going to increase inflation, not of those goods that are increasing abroad, like foodstuff or energy, is going to increase inflation internally, and that the central bank will have to act upon it. And that, I think, is what many Latin American central banks are doing, is help the fiscal stance to contain pressure, having a hawkish attitude, and showing that any concession on the fiscal side will come together with more aggressive policies on the side of the central bank. But if you can contain these pressures, of course, will be best for inflation. Now, a minimum wage again goes back to these policies to help the poorest part of the population, but has to be very careful about other implications these policies may have, and that depends on particularities of each country. About inflation targeting, how efficient is, I think if we had not inflation targeting in Latin America at this point, we will be in another event of very high or even hyperinflation in most countries. That's what we had in the past. And the proof that inflation targeting is working is that expected inflation in all these countries is way below what current inflation is. It's not easy politically to sustain inflation targeting when you have a very high inflation, because that calls for interest rate tightening and for fiscal discipline, and many times politicians and also pressure groups want more fiscal spending, lower interest rates, and it's not easy, as I said, but it's proving to be very effective.
Thank you, Igal. Let me go to Deepak, and I suppose, Deepak, the theme that's really emerging here, it has been throughout these questions and some earlier, is the secondary pressures, a second round of pressures coming after the initial impact of the rise in commodity prices. As governments try to deal with their internal pressures, you could set off another round of pressures that could drive inflation higher, and that's probably where a lot of these questions are coming from.
That's absolutely right, and it is politics matters a lot in making these decisions, and we realize that there are political compulsions in many of these countries which have to be taken into account. They cannot be ignored. However, while taking these political actions, it's important not just to focus on the short run, but to think of the long-term consequences. I don't have much to add to what Igal said, but in response to the question that Kunkirida asked from Bangkok, for example, it's very important here, when you look at the minimum wages and eventually also at what happens with public sector wage setting, it is important, it is a political issue, it is an important issue that needs to be tackled, but alternatively you've got to focus on what this will do to wage setting behavior in the future, inflationary expectations, and whether or not there are elements of the social safety net which are better targeted towards the most vulnerable groups, that are better instruments to deal with the political aspects of this problem. A minimum wage is an economy-wide measure, and although it is only probably introduced in urban areas or implemented in urban areas, it does have consequences for all kinds of price setting and wage setting behavior across the spectrum. That is important. The other consideration, I think, and this is the questions both from Indonesia and from Thailand, which Mr. Magenzo made, I think, fairly clearly during his presentation, was that yes, appreciation is a useful policy for imparting some deflationary pressure on domestic prices. However, for countries especially like Thailand, which are concerned about the regional and global competitiveness of its manufacturing industry, appreciation will have certain strong, will impart strong competitive pressures on certain segments of the industry, and therefore this balance needs to be watched fairly carefully. The question then is that what can you do in getting a little bit more exchange rate flexibility, in widening the bands around which you operate, so that the private sector, manufacturing enterprises, learn the culture of dealing with currency fluctuations, but you avail of whatever opportunities you have to reduce prices through an appreciation, and yet keep your eye on the competitiveness of the key sectors, not necessarily the commodity sectors, which are still fairly important, for example, in Thailand and Indonesia, but mainly on the manufacturing sector, and those probably at the lower end of the value-added spectrum, where you're operating on very, very thin margins. It's not easy. There is no solution, but this is a standard complement of tools which need to be balanced in introducing a coordinated policy response.
Let me further defend appreciation, and I know, and it's also the case in Latin American countries, that it's not easy to implement this policy, but at least it's important that the policymaker has it clear that this would be the desired outcome. And it's important to know where the appreciation is coming from. In the case of Latin America, for example, it's coming from commodity, from primary goods exports. So big terms of trade, that's the main, what is mainly driving the appreciation. If you suspend the currency, then what you're doing is actually subsidizing exactly those who are getting the gains. So those who are having huge increase in incomes because of selling foodstuff or mining metals, etc., you will allow them also to spend the money at home at a more convenient price. And that will build further pressure for the appreciation of the exchange rate. And if it doesn't come through the exchange rate, it will come through higher inflation. There is no way out of it. And that's what the Latin American experience has shown. If the appreciation comes from capital inflows, to defend the value of the currency is the best incentive to bring more capitals. And also we have in Chile that experience during the 90s in which we tried to have an exchange rate band to defend, to avoid appreciation of the currency in face of huge, massive capital inflows. And what you had is more and more inflows all the time. And at the end, the currency had to appreciate anyways in the middle of speculative attacks against the central bank. So it's appreciation in a disorderly way instead of appreciation in a regular way where the markets can act accordingly. It's very important to develop financial markets for insurance. To allow the manufacturers to take insurance against exchange rate appreciation so that they can cover themselves. Otherwise, the exchange rate becomes the main business of manufacturers and not their own business. All these are lessons that have been learned through time the hard way. I hope other countries can learn the easy way from others.
Igal, there was a specific question from Papua New Guinea about Chile and its current policies and how it's going to withstand the global increase in inflation. I suppose you would say you'd have the right range of policies in place because you're the one giving the advice. But how do you see Chile dealing with the pressures over the say next 12 to 18 months? Inflation rises globally. What will be the impact in Chile?
Well, I think the most important is that in Chile we have been able to keep expected inflation down and that we have been able to keep second round effects very controlled. So wages are increasing way below inflation, and if you see measures of core inflation, they are going up, but not as dramatic as overall CPI. So I would say that this framework of inflation targeting and independent central bank, together with strong regulation of the financial system and together with fiscal rule that forces discipline to the fiscal authority is now being put to test. So far has gone okay. With a lot of political pressure to go otherwise, and it's maybe too early to give a final verdict, but we believe, at least we at the central bank, maybe too complacent with ourselves, believe that we are doing the right thing and that hopefully we will be able to go out of this cycle in a better way than we did in the past, which I would say again, at this stage we will be having huge, enormous second round effects, and we will be defending the value of the currency, and we will be experiencing very high, if not hyperinflation.
Okay, we have a few minutes left before we have to wrap up our session. I'd like to go to Mongolia, Ulaanbaatar, and get some follow-up questions from you if you have any.
Yes, we have a couple of questions. Stanley, just wait for a minute here. Mr. Bold.
Yes, World Butter from the Bank of Mongolia. First of all, thank you very much, World Bank, having this great opportunity to share our opinions and learn a lot. And the Mongolia is quite a trade-dependent country in a bad sense, and in today's circumstances, appreciation of national currency would be preferable. Yes, I agree with this one. and I will convey this message to my management and so on. And I fully support the idea that fiscal discipline is the basis. Yes, without the fiscal support, the containing inflation in Mongolia seems virtually not possible. Well, I had two questions, but the one already been asked from our the colleagues from Thailand. And the second one is, could you please give a very short little detail on how to contain, how to anchor inflation expectation? Since here in Mongolia we haven't yet fully implemented an inflation targeting. Yes, inflation targeting is the one of the way, but if there is no inflation targeting, what would be the recipe for the anchoring expectations? Thank you.
Thank you. Any others?
My name is Andrea. I'm from the Consumers Association. We now know that the capital flow is quite limited, and the business people have difficulties in accessing the loan and credit. And what will be the difficulties related to the loans?
Sorry, could we just repeat that? We didn't quite understand that question.
These days the interest rate for loan is very high, and there is a limited access to the lending. And then in case if business people will take this high interest loan, what will be the long-term effect on the businesses of this loan?
Sure. Okay, we certainly get that. Now, could I just go? Perhaps we'll come back to Mongolia for some more later, but could I just go to Dili, because I know Timor-Leste is about to leave us. Any questions we could answer for you in the short time you have left? Dili? No? No one there from Dili. Okay, let me just deal first of all with the questions from Mongolia. I suppose the second one, if we can start with that. The second one is that if interest rates go higher, how is that going to impact on the business community in Mongolia? It's going to make money more expensive and tighter, more difficult to get. How will that affect the business environment? Perhaps, Deepak, you may have some insight to share there?
Well, let me address this one specifically to Mongolia, because it doesn't apply as much in the current circumstances to some of the other countries. But the access to credit is essentially a phenomenon limited to a small set of Mongolian enterprises outside of the government interest programs for outlying areas for rural communities. Now, access to credit at the moment is an important issue only insofar as these interest rate changes affect the behavior of these firms. Now, most investment in a manufacturing sector in Mongolia, and I'm talking not about the real estate investment sector, but specifically manufacturing sector or in the trading sector, is funded internally. A huge proportion of this investment is funded from internal capital, and therefore the elasticity of demand with changes to interest rates is not very high. So while the interest rate will obviously affect certain enterprises, it is not very clear that a small increase in interest rates is going to have too much of an adverse impact on manufacturing demand or on new capacity which is being put into place. Essentially because the new capacity which has been put into place in Mongolia is so heavily dependent on the public investment program, which is funded out of general revenues.
And there was another question, and I think I might address this to you, Igal. You've talked about the need to set inflation targets. The question there was, are there any detail about how to anchor inflation expectations apart from directly targeting?
Well, first of all, let me say that from the questions we're getting from all these countries, I would say that what is very looks like very good attitude is to face the shock. We cannot turn bad news into good news. There is a war inflation shock. This is bad news, and this is going to hit every country, and this is going to be bad news for every country, and we cannot avoid that. We can live in denial, as I would say Argentina, Bolivia, Venezuela are doing, or we can face the shock and try to do our best, and I think that's the attitude I'm getting from all these countries. With respect to this particular question, unfortunately, credibility is something you build over time. It's just like a marriage or any situation like that. You build it over time, you lose it overnight. So I would say it would have been much better if countries started before with an inflation targeting regime in tranquil times, and you can build credibility in tranquil times to use it in these hard times. Nevertheless, if that's not the situation, you will have to be more aggressive, and that I think is the lesson, is to show preoccupation for inflation, publicly show preoccupation for inflation, and act upon it. Start tightening fiscal policy, start tightening monetary policy if possible, to show that you will not allow inflation to go out of control, and you are able to go very far, you are willing to go very far in order to contain inflation. So I would say what credibility, what you gain with building credibility and anchoring expectations through time is that you don't have to act so aggressively afterwards. If you didn't do that in the past, I would say the only way out of it is to be more aggressive. It's not an impossible task. I know Mongolia had a very high inflation in the past. It has to be made clear this is a different event, this is a different fiscal and monetary policy stance, and that you're going to act differently than you did in the past, and that you have learned the lessons, and you would say we don't want to become a Latin American country. That might help.
Okay, we are almost out of time. I'd like to just offer the opportunity for a final round of comment, or one question each from our remaining sites. Let me just start, seeing as we're on Mongolia. A final comment, a final question, Ulaanbaatar?
Anybody here?
No, thank you very much. Then I think
thank you.
We're fine.
Thank you. Your contribution has been terrific, so really appreciate it. Indonesia, Jakarta, University of Indonesia. Any final comment or question?
Thank you.
Thank you. Papua New Guinea. Anything to add?
Sorry, from Denpasar, Udayana University.
Oh yes, Denpasar, we have you there. We've had some problems with the technicalities, but I'm glad you're online now. Could you make any contribution, any questions, any comment?
Yeah, we have one question so far. We'd like to ask Mr. Eagle. We would like to ask on specific questions on compensating the poor. So, as one of the tools to control the inflation. So how do you in Latin America taking it into actions? And in Indonesia, as the effect of the rise in oil prices, therefore many people come down living under the poverty line. So therefore the government are taking initiative to give a compensation for the poor, giving them a cash worth 300,000 rupiah is given every 3 months. So in which way that do you think that giving compensation to the poor would lead to control the inflation? Thank you.
Thank you very much for that. Any question from Papua New Guinea?
No questions, Stan. Just a comment. Thank you very much for the presentation by all the presenters, and we've learned a lot here today. Thank you, Stan.
Thank you. It's been our pleasure. Thailand, Bangkok. Any final comment or question?
No, we don't. We just like to thank all the presenters and to you, Stanley. Thanks.
Thank you very much. Well, let's before we wrap up, let's address that question then to you, Igal. The question was, in an environment, as you've said, where fiscal discipline is important, you also have the added pressure of protecting the most vulnerable. What are the measures that could be introduced to ensure that poor people are not more disadvantaged than they need to be? And can or should people be protected from passing on the full costs of things like the increase in oil prices?
Well, I again will insist that you cannot turn bad news into good news. That will be for the poor, that all of the sudden you have inflationary pressure and the government remembers that there is a part of the population that is living in very hard situation, and that will be good news for them, that we have a bad shock. That will probably not happen. I would say you have to compensate the poor. You may consider subsidies to food prices, to energy prices. This is being done in virtually every Latin American country. You have to support more programs that give, we are increasing our programs to give breakfast at school, food to kids. We are giving bonus to all people, but we are being very careful of the fiscal implications. This is not going to help to reduce inflation. Quite the contrary. Most likely it's going to put more pressure on inflation. One thing that is very favorable for the poor is to keep inflation down, is to allow the exchange rate to appreciate, so the price of imported goods does not go up by as much, and is to reduce inflation. So I would say compensate the poor, yes, beware of fiscal spending, because that can at the end harm even more the poor. If you enter in second round effects and inflationary spirals, the ones that are more affected by inflation are always the poor, especially when inflation comes from energy and food prices.
Thank you. Deepak, before we go, I'd like to afford you just a final comment. We began today, I recalled a quote from the former Australian Prime Minister and Treasurer Paul Keating, who had to grapple with very high inflation during his term in office. And he said fighting inflation was like grappling with a column of smoke. You have it and it changes shape and moves on you. We've heard today of that inflation appears to be here to stay, at least in the short to medium term. Commodity prices are going to remain high. Countries face different internal pressures, and they're having to juggle with a suite of policies to try to combat it. Any final comment from you about how the international community should approach this? What is a coordinated approach that is needed, and how do you protect those most vulnerable?
Thank you, Stan. Let me try to wrap this up by saying that obviously the first point to focus on is the need for a coordinated policy response at the domestic level, and to the extent possible where the international community can effect some of the international dimensions of this problem, for example in both the supply response in certain sectors critical to inflation pressures in the world economy, or in terms of risk management, then that should take place, and I outlined some of these earlier. But the domestic policy response is obviously the one that policymakers are focused on, and here the coordinated policy response is important. The second thing to keep in mind is that it is not an easy subject to deal with. There are consequences in domestic economies which are quite serious, so politics does play an important role, but throughout this process it is important to keep in mind that the short-run solutions may not be the best ones from the medium and long-term point of view. Igal pointed out the fact that the people who are hurt most by inflation are the poor, and therefore any sorts of policies which are oriented towards